Infrastructure demand is booming, but should you build up your investments? This is Inside ETFs, and we're talking about infrastructure, a sprawling category that includes bridges, railroads, and data centers. Infrastructure can inject investors with a sense of ownership in the economy. An energy bottleneck sparked by the rise of AI is spurring demand for new infrastructure investments. But big projects are hard to value and sell. That's a risk for your portfolio when you need your money back in a pinch. Jay Hatfield, CEO of Infrastructure Capital Advisors, is ready to pounce on the demands. So Jay, some have argued this is the golden age of infrastructure. Do you agree?
The great thing about infrastructure, particularly for more conservative investors, is really the definition of infrastructure is long-lived assets. And so you get much more stable cash flow if you're focused on steady income, particularly if you're thinking about retirement. Both public and private infrastructure investments can be very attractive because these are assets, they're not like service businesses or even tech businesses that can have big downturns. So for critical infrastructure, very reliable, long-term cash flows, very conservative.
Companies do often, though, come around and contribute to an infrastructure project and then go away. So how can investors invest long-term in infrastructure ETFs?
We'd actually counsel people to kind of know what you're getting. Like if you want to buy airports, then there's some great publicly traded companies in Europe that you can buy directly even. So we would rather, if you're going to do infrastructure, do it by sector. And we do count real estate as infrastructure because it is very long-lived assets. It can be data centers, it can be towers, it can be data telecom related. So we would look at doing sectors in infrastructure rather than just a general fund, because depending on which fund, you get a lot of different mixes of those sort of assets.
Well, let's look closer at one of those sectors, and tech giants are racing to control their own infrastructure in the AI boom. How does that play into your strategy of where the value lies?
So we do hold some of the data center REITs. So that's a good example where REITs are really infrastructure. And those companies have done really well, like DLR, because there's excess demand for their services. So you can, same thing, you can play that. A lot of that building is happening, by private companies and even by the AI companies themselves. But you can play it through those pretty conservatively structured REITs that do pay dividends as well.
Meanwhile, President Trump has stressed the importance of using coal, nat gas, and nuclear to satisfy the rising AI demand. Is investment into clean energy infrastructure less in demand now?
I don't think it's less in demand. I think people are just being more realistic that renewables are site specific. So in other words, wind power doesn't work in Manhattan. Solar doesn't really work in New England. And so it can't be solely relied on. We're not a big fan of coal, so we would be more focused on the natural gas boom. Nuclear takes a long time. It does produce nuclear waste. But natural gas is really the key transition fuel. You're going to see it in Europe. The recent trade agreement had a big commitment to purchase US natural gas, which is a pretty easy commitment to make because we have the cheapest natural gas in the world. Our gas is 80% cheaper than the rest of the world. So I would focus more on the gas side of it. That's super clean fuel.
So the demand for infrastructure is clearly there, but Trump's tariffs will affect prices for raw materials, equipment, and goods. Can infrastructure investment justify the high cost to entry?
We think so. There's something dynamic that people always forget, which is markets clear. And what that means is that if it's more economic to build, steel or manufacture steel and aluminum in the U.S., that'll happen. If it's more efficient to import it, that'll happen. And the demand for AI and data centers is so significant, it's not going to be impacted by the fact that maybe the electricity is a little bit more expensive because the steel and aluminum is more expensive or the cement's more expensive. So the market will clear just due to the fact that there's fundamental demand that's going to overwhelm any minor cost pressures.
So finally, Jay, you mentioned real estate, and the National Association of Home Builders are reporting that the sentiment amongst residential construction firms has collapsed. So how would a drop in the real estate market affect the performance of your ETFs?
What typically happens when you have a monetary tightening is the housing sector, it's not all real estate, but the housing sector is headed into a recession. So the Fed needs to cut. And we do think that at the meeting tomorrow, they will signal that they're going to cut in September. And that'll take pressure off the housing sector and will avoid a recession. So we're not forecasting recession. If there is a recession, it's bad for all stocks and bonds. So that would be negative. But we think the Fed will respond finally, and too late, but respond, and that will head off a real estate or residential real estate collapse.
That was Jay Hatfield of Infrastructure Capital Advisors. Don't forget, you can watch more videos on Reuters.com.